Okay, so let's kickstart today's session. So for today, we will be looking at price action trading. And so it's a combination of supply, demand, as well as market structure. So just a quick introduction of myself. I'm Lee Singh. I provide FX advisory to institutional clients. You can also find me on LinkedIn. So if you have any questions with regards to the sessions that are done, and these sessions are recorded, so you can also find them on YouTube, right? So just go to vantagemarkets.com/webinars on YouTube. You should be able to see them. So if you have any questions, right, please feel free to put them under the questions tab. So this is the agenda that we will be covering for today, right? So first, we will be taking a look at how we can combine different time frames analysis, mainly looking at market structures, right? So there are 3 types of market structure we covered in detail last week. So for this week, I'll be running through them as well as going through a few examples from them on TradingView in a while. Right, so that's what we will be covering, and following which we will be taking a look at supply and demand zones. So how we take a look at entry, stop losses, and take profit targets, right? So how we can use these zones to help us in identifying this entry, stop losses, and take profit target levels. And finally, right, we take a look at risk and trade management concepts. So in general, try not to over risk on one trade, right? So anywhere between 0.5% to 2% on each trade. Try not to risk beyond that. So in terms of risk, right, it's based on 2 things, your lot size as well as your stop loss, right? So in general, if you have a tighter stop loss, so let's look at this example, right? So if you have a much tighter stop loss where you're taking a sell position, for example, right, and you're taking an entry, which is here, and your stop loss, it's assuming 10 pips, right? And you have a take profit target of 20 pips, then essentially your risk to reward ratio, if it hits your full take profit target, it's 1:2, right? So basically you are risking 10 pips, and if it hits your take profit, it's 20 pips, right? So in this case, right, when that happens, you can see that with the same amount being risked, right, if you keep a tighter stop loss, you can actually get much higher returns. Why? Right? Because if I keep a tighter stop loss, so let's say if we now keep this stop loss to 5 pips. So if we keep the stop loss to 5 pips, essentially you can see that you're risking 5 pips for 20 pips. So in that case, right, your risk to reward ratio becomes 1:4, right? So that's how with a tighter stop loss, you can get a much higher return with the same lot size being risked, right? Of course, if you're risking the same 1%, you'll get much higher returns because you have a higher risk to reward ratio. At the same time, right, with a tighter stop loss, with the same percentage of equity being risked, you actually can open a bigger position. Okay, so let's take a look at the general multi-time frame analysis first. Right, so I'll share a bit more on how I go through the different time frames, and following which, right, we will take a look at market structure. So I did cover this last week, so we'll just take a look at them briefly and also how we can apply these concepts. So let me just bring up TradingView and we'll walk through them together. Okay, so before we hop on our TradingView charts, let's just take a look at the general concepts. So for this, right, we will go on to the next slide. Okay, so let's understand a bit more on market structures, right? So markets in general can be categorized into three structures. So your uptrend, downtrend, or bullish market structure, bearish market structure, and a ranging market. So in an uptrend, essentially, we should be seeing clear successive higher lows and higher highs. Right, this can be done, right, either looking at prices in close. So if you go to TradingView, you can actually switch the different mode of the charts, right? You have candlestick patterns, you have the close price, right? So in this case, these are line charts. So if you see successive higher lows, higher highs, then in that case, prices are in an uptrend. And the assumption is that in an uptrend, right, the highs themselves are constant targets. We can use them for take profit targets, and the lows should not be broken, right? So if there is a sign or any signs of a change in trend, usually we first observe that on the lower time frames, and we will see that there is a change in market structure. So this is an example on the left, right? This is an example of how it looks like in line chart. And on the right, this is what we can see when we load a TradingView chart. So you can see clear successive higher highs and lows, right? So the peaks and troughs are marked out in blue and gray. So that's an uptrend, right? And likewise, the same thing applies in a downtrend. So we should be seeing clearer or lower lower lows and lower highs. And in a downtrend, you can see that the lows are constant targets. So in this case, right, when price pulls back in a downtrend, if the downtrend continues to hold, we're not expecting the price to break above the high. And you can see that when you take a look at what we have to the right, this is basically what we can observe in a downtrend, right? So any pullback itself, it's just mitigation into the supply zone, right? So if price did a pullback, it pulls back into a supply region or resistance area before it continues to the downside. And downtrend itself, it's seen when price breaks below the previous low. So you can see that these lows themselves can be used in a downtrend as profit targets. So if you're selling in a downtrend, right, this is definitely one area you want to consider, right, in your take profit target. And what's also interesting to note is that generally in a downtrend, we can see that any pullback within the zone itself, the high still holds, right? So the high itself is not broken. But this also means it's that if we are seeing a move like this, right, where prices are forming a lower lows and lower highs, when price pulls back into a resistance area, right? So on your higher time frame, if it pulls back into a resistance area, we can apply different concepts, right? It can be interaction or rather price coming into a moving average, which acts as a dynamic resistance. It can be price coming into a supply zone, right? So if you're looking at consolidation, right, supply zone on the higher time frames can be represented by dojis, right? So I covered in the earlier session that basically doji, if you take a look at it, right, if you take a look at a doji on the daily time frame or even the 4 hours time frame, if you move it down to the lower time frames, essentially it's nothing but consolidation on your lower time frames, right? So we'll take a look at a few examples on that later. So in general, right, when there are ranges and price breaks out of this range, right, then it revisits these areas and this can be a new supply zones. So we'll take a look at examples on the chart for that later. So another thing to note is that over here, right, so if price pulls back within this whole leg itself, right, if the assumption is that the highs themselves should hold in a downtrend and the lows are constantly broken, but this also suggests is that these highs, right, these levels can also be areas that we can consider putting our stop losses. So if price breaks above the high, right, then this is a sign that there is a change in trend and we want to get out of the position. So then another thing we want to note is that within this range, right, so assuming that price breaks the previous low and we're expecting price to hold within this range, right, this whole leg, so assuming that this is a 50 pips move to the downside, right, or even, yeah, so 50 pips move to the downside and price did a pullback, we want to understand that in a downtrend, the higher the price goes, right, so if it pulls back further in a downtrend, then this itself would be actually a better price to sell at. So more, yeah, so it's a better price to sell at, right? Essentially, you're selling high and buying low, right? So when price pulls back, right? So this can be measured based on a few indicators. It can be based on your moving average, right? Price crossing below the moving average as confirmation. It can be using Fibonacci's, right? So if you take a look at Fibonacci retracement, it can be using 50% as the reference point. So what this means is that, so let me just bring up the chart, right? And we can take a look at this in a clearer example. And so let's say we have euro dollar. So euro dollar recently has been on a downtrend, right? So let's take a look at that. Okay, so let's take a look at euro dollar here. So you can see that prices are forming your lower lows, lower highs, right? So it's forming clearer lower lows and lower highs. So let's take a look at this value, right? So you can see price moving down, and this is the pullback leg. Let me just clear all the drawings so that we have a clearer picture, right? So you can see price forming a lower lows and lower highs. And in a downtrend, you can see that the first sign of a trend is first the break in structure, right? So we need to see price break below a low. So in this case, this is the break in structure. We saw price broke below this low. And once that happens, right, the assumption is that price could continue to pull back before it continues to the downside. But this high itself, so the last high that broke structure, so this is the high, right? The last high that caused the break in structure would hold, right? So if price continues and it breaks above this high, that's when we want to get out of the position. So we know that the range that we're looking at, just based on market structure alone, right? This is the last range that we have. Of course, the higher the time frame you are, right? Right now I'm on the 4 hours, right? The higher the time frame, the lesser the noise, right? If you're on the lower time frame, you can see that, let's say on the 15 minutes or 5 minutes, you might be seeing constant change in market structures. So in this example, right, it's always important to use a higher time frame. It can be your daily, your weekly, right, as a guide in terms of the trend, right? So the direction of the trend and using your lower time frames as entry. So back to this point on the 4 hours, you can see that when price pushes down and breaks structure, this is the last range that we are looking at. So imagine if you're within this range itself, right, and you're looking for positions to sell, it would make more sense to sell if price pulls into this zone, right? So anywhere beyond the upper half of this range. So if this is the whole range, we want to look at the 50% of this move. So if price goes beyond that, right, then we are in a better position by getting a better price to sell. Whereas if it's just doing a slight pullback, right, below the 50%, right, price could continue on the downside. If we're not taking any positions below the 50%, then essentially, right, it also means that we could be missing out on these opportunities. Okay, but this is just sharing how we can actually use Fibonacci retracement and market structures combined. So in this case, you can see that if this is the range, right? So what I want to do, so let's just do a quick replay on this, right? So you can see that if this is the range and price starts pulling back over here, and we know that this is the last leg, and this is the last leg because this is the last high that caused a break in structure. The high took out the previous low, which is this low here, and broke structure, and right now it's pulling back. It's coming into a supply zone, and we're trying to find areas to sell. Why? Because on your 4 hours time frame, it's showing you bearish market structure, right? And if you're on the daily, we went through this in the earlier sessions, right? On the daily, it's showing bearish structure too, right? Based on break of the previous low. And also we can see that demand zones are failing, right? And supply zones are starting to hold. So we have went through that analysis on the daily in the previous session, right? So I'll just leave it as that. If you are keen to explore further, right, do take a look at the recordings. But in this case, you can see that when price did a pullback over here, right? So this is the whole leg itself. So what we want to do is do a 50 retracement on this move, right? So what we're trying to do when we actually apply a Fibonacci retracement on this move is that we're trying to find if there are any levels, right, or any zones itself that we are looking to enter. So in this case, if this is the whole leg, right, what you want to do is take a retracement of this move, right? So recall that when we're applying Fibonacci retracement, we want to find the highest point and lowest point, right? So we're trying to use these levels to see if they are in line with any of the zones that we've highlighted. And if so, right, then maybe that gives a higher probability setup. In this case, when we do a retracement, where we're trying to identify the highest point, so that's the highest point. Now we're trying to identify the lowest point, right? So I start from the highest point and I end at the lowest point. And once we do that, right, so you just open up the retracement levels. These are the default levels here, right? So what I want to highlight is that in this case, I'm looking at 50% and beyond, right? So if price goes above 50%, right, essentially this is a zone where I'm in a better position to sell. So let's say the levels above 50%, we have 50, 61.8, 78.6, right? Not beyond 100. And of course, the other one would be 88. Okay, so these are the levels. So in this case, right, what we're trying to do here is that we're trying to find, right, if price goes beyond 50%, 50% essentially is half of the leg. So if we are at 197 to 59, right, this is about 60 pips. Okay, so, sorry, 160 pips. So in this case, right, if we are looking at this whole move itself at about 160 pips, right, so 160 pips, so half of it is about 80 pips. So which means that if price moves down very strongly for 160 pips, and it did a retracement, right, of more than 80 pips, then in a way it's a better price to sell as compared to just doing a slight pullback. And not to say that it would not push lower, but it's more of a probability, right? And also risk to reward ratio. So let's say if we're doing just purely based on market structure, right, we can identify sell zones, right? So just using retracement, we can place sell entry. So the higher, the better. But of course, in this case, right, if price doesn't pull back into this move, your sell limit might not be triggered. So yeah, that's the pros and cons of this, right? So we might miss the setup. But in this case, of course, if you keep the entries right nearer to the highs and your stop losses slightly above the highs, because this is where we are wrong on the trend and we want to get out of this trade, right? So in this case, you can see that if I have my entry here, so let's say this is the entry, right? So if I have my entry here and I have the stop loss over here, right? So I'm targeting the previous low as the profit target. You can see that if I were to put the entry at the 78 and 88.6, the risk to reward ratio would change accordingly, right? So if I put at the 78.6, you can actually use this tool, right? So this tool over here helps us to measure the risk to reward ratio, right? So you can do a short position. So we're essentially selling, right? So entry over here, stop loss just slightly above the high and TP at the previous low. So you can see that if I put the entry at a 78.6 retracement, right, of the last leg, this would be at about 2.42 risk to reward ratio. But if I were to move it slightly lower, right, so if I were to move it, let's say here, right, then in this case, this would be a much lower ratio, right? So this is at about 1.3. So what this means is that the lower the entry, right, then in a way you can get a ratio that is less than 1. So this is not ideal in our case, right? So ideally we want to target anything that's more than 1 or even 1.5. So if it's 1.88, what this suggests is that when price it's or even at 2.27, right, what this suggests is that for every dollar that you risk, right, you're getting 2.2 in return when it hits your full take profit target. Okay, so that's what we have, right, in terms of risk management. And also another thing to note is that when price goes in our favor, right, what we also want to consider is that let's assume that price pushes up into the entry and it continues to the downside. Then in this case, oops. So let me just exit this. So if the price continues into the entry and it pushes to the downside, right? So when price comes into this zone, this itself is a weak low, a constant target. So when price pushes into this area, this is an area we want to consider getting out of the position or even taking partials. And more importantly, trying to trail our stop losses. So in this case, if price pushes lower, right, then this is an area we want to consider. Okay, so at least to take partials or even just shifting our position to break even. Okay, so this is in terms of market structures. Of course, you can take a look at it across different time frames. So if you take a look at it on the daily time frame or even the 4 hours time frame, right, the higher time frames will show you the direction of the market, whereas the lower time frames can be useful for entries. Okay, so let's take a look at another example. So you can see again, right, this is the picture on the 4 hours, right, or even on the daily. So we have the same structure. So in this case, you can see pushing into this zone, right, we have prices breaking structure. And the change in structure comes when price breaks below this low. So that's one. When you move on to the 4 hours time frame, so what we have on the 4 hours, you can see that just with the most recent price movements over here, right, prices are forming your lower lows, lower highs, pushing to this zone. So breaking structure. So in this case, this is the last high that we have. It broke the previous low. So this is the last leg of the move. So in this case, right, let's apply the same concept. This is the last leg of this move. We're still in a bearish structure because we saw the break of the previous low. And this is the whole range that we have, right? So this is the last range that we were looking at. So this is the range from the highest point to the lowest point. So we take the highest point, the lowest point, right? So we are doing the same thing, essentially looking at anything above 50%. So which means that when price did a pullback of this move, right? So let me just do a quick retracement. So anywhere here, we can see that when price did a pullback, it first reacted at the 50%. And then on the 61.8, 78.6, and then the 88, right? So if I move along with this, you can see that if I do, again, a replay of this, right, price actually pushed up. So you can see, so we're looking at anywhere beyond this low. So this is the lowest point. So you can see what happened, right? Price pushed into the 78 before it did a retracement of this move. Okay, so in this case, you can see that when price did a pullback, right, or retracement of this move itself, right, along the way up, right, if you have to enter positions at 50%, 61.8, of course, right, we'll see a slight drawdown eventually before price turns into a profit. But this would, of course, come with risk, right? So if you're entering at a 50%, right, and putting the stop loss above structure, above this high, then you can see that the target for the profit would be the previous low. Just looking at this structure alone, you can see the 50% as the entry, stop loss slightly above the high and the low, right? In this case, this risk to reward ratio doesn't cut it. It's at 0.9, which means that if you risk $1, even when it hits your full take profit target, you're only getting back 90 cents. Right? So that's, of course, you can multiply that based on, if you're risking $100, then if it hits your stop loss, you're risking 100, but if it hits your take profit, right, you're getting $90 back. So essentially what we're trying to do is that we're trying to target an area where risk to reward ratio makes sense, right? So that you don't have to be right more than 50% of the time, but you can still be profitable. So in this case, right, you can consider, right, either having maybe a filter, so that at every level, right, filter for the ratio. If the ratio is more than 1 or 1.5 or even 2, right, that's when you want to consider putting the position. So just basing on market structures and Fibonacci retracements. Okay, so in this case, you can see that if I were to shift this up, right, so if my entry is higher at the 78.6%, so let me just shift this higher here, you can see that just by changing the entry, right, the risk to reward ratio, it's significantly higher, right? So at the 78.6%, your risk to reward ratio for the same and stop loss and take profit target, it's at 3. Okay, whereas at 50%, it's only at 0.9. So this is something to consider, right? Of course, on the higher time frame, we'll have less noise, less sweeps as well, right? Because on the higher time frames, the structures are clearer. So of course, right, with that clearer structure, we also have a much higher or wider stop loss. So that's the trade-off. Okay, so that's another example where we can use market structure. Right, so you can see that, of course, we always need to use the higher time frame to determine the general direction and the lower time frame. So once you have determined on the daily or even the weekly to be more bearish, you can use the 4 hours or 1 hour, right? Just in a bearish or in a downtrend, right, we're trying to look for bearish market structures. And once that happens, right, we can use the retracement levels, wait for any pullback as the entries, just put the stop losses slightly above the high, target the previous low, right? And you can do a filter where if price or if the risk to reward ratio, right, based on all these entries, if the risk to reward ratio is less than 1.5 or even 2, right, that's up to your own discretion. In that case, we want to filter the trade, right, and move on to the next level. Okay, so that's what we can consider, right? So this is in terms of market structures and Fibonacci retracements, right? For those of you guys who are not familiar with Fibonacci retracements, right, we actually have a session on that. We covered a series on that. So you can take a look at the recordings on YouTube. So in general, right, maybe just a quick overview of how we use retracement levels. So you can see at every interval, there will be a level, right? So what we're trying to do here is identify the general direction first and use these levels as potential entries, right? Of course, using the same example, right? So if we're looking at this range of high to low here, right? If prices are trading within this whole range, you can see that in a downtrend, we try and enter or try to get prices, right, higher up, because the higher it goes, right, as long as it holds within the structure, then it gives us a better risk to reward ratio. We saw this example using the different Fibonacci retracement levels, right? If we enter at 78.6%, you see a risk to reward ratio of about 3.04. But if you enter lower at around a 50% level, which is here, right, your risk to reward ratio, it's only at about 0.9. So you can see here, right? So you keep the stop loss and the take profit targets the same. Switch the entries, you can see the risk to reward ratio, it's very different. So in this case, right, when we have a bearish structure, what we want to look for, right, it's basically trying to filter all these levels, right, which are the levels that can give us a higher ratio. Okay, so that's what we have for today, right? So mainly combining market structures as well as retracement levels, right? Of course, coupled with that, if you want to combine them with supply demand areas, instead of just taking levels beyond the 50%, what we can also do, right, it's to try and find, right, within this zone itself. So in the previous session, I highlighted dojis as representations of range in the lower time frames. So in this case, when prices are in when prices are showing doji candlestick patterns on your higher time frames, right? If you zoom down to the lower time frames, they're actually range. And when price breaks out of this range, right, they usually retest them again. So if it breaks out of this range, which previously serves as a support, it broke out of it, retested, and that range itself would serve as a resistance. So one other way to look at it, it's like, apart from just looking at retracement levels, right, is to see if this retracement levels actually coincide with dojis on the higher time frames. So that could be another filter that we want to add, right, to our strategy. Okay, so if there are any questions, right, please feel free to put them in the chat, right? If you want to take a look at a recording, right, just go to our website and you can actually find the recordings on our YouTube page. Okay, so if there are no other questions, then that's what we have for today. Right, so thanks everyone. Have a great trading week ahead, and we will catch you guys again tomorrow.